Welcome back to Switzer. For a fund manager's view on what reporting season has shown, we have Roger Montgomery of Montgomery Investment Management. Hi, mate.
How are you?
Good. Do you get really excited, pre-reporting season? Because, your whole life is making assessments on companies and all that sort of stuff. And you obviously have a pretty good feeling of what they're going to report. But there's obviously times when you're quite surprised either on the high side or the downside.
Well, I think there's going to be more surprises in the future than there have been because less companies are providing guidance now.
Right. Now, what's that?
So, well,
it's not necessary for them to do it?
Well, it isn't. And if they do, then they have to commit to that number. There's a big push on in the United States for companies to stop providing guidance. Warren Buffett and a few other very high-profile people and investors signed a sort of a general, if you like, general advice guidelines, and they were suggesting that companies that provide guidance that look like they're going to miss that guidance are tempted to then do things untoward to meet that number. Hillary Clinton came out and said we've got to get away from quarterly management, and she's absolutely right.
Yeah, because quarterly is excessive, isn't it?
It does seem excessive.
I think our half year is not bad.
So what's happening now, though, is we're seeing a wider spread of analysts' estimates. Yeah. So the consensus number now, which is an average of those estimates, is arguably meaningless. It used to be the company would put out guidance and then that would be your anchor. There'd be anchoring bias and an analyst would be, a couple of cents lower or a couple of cents higher. Now they're much more spread out. So you're seeing more and more analyst reports, certainly this reporting season, saying the company met consensus but missed our numbers by 2% or exceeded our numbers by 2% because the spread's so wide. That creates opportunities, I think. I think the funniest thing that you can read is a report that says the company missed our estimate. Well, whose fault was that? Was that the company's fault or was that your fault? You're the analyst.
Yeah.
So in answer to your question, we don't get particularly excited. We're fairly even-keeled about these things. I've got to tell you, though, we talked about it off-air just before I came up, that we went live. I'm more excited about Isentia, given that we've had people calling up saying what is, quote-unquote, boy one to think when the share price was down and here we are at new highs and they reported absolutely phenomenal numbers.
But let's talk about that, Roger.
Sure.
Because, what goes wrong with market communication that a company like that gets, bagged and the share price falls? Yeah. And when I put it to you, when a viewer complained, because you were a supporter of the company, you said, well, on my tracking, it's doing pretty well.
It's going very well.
Yeah.
And it did.
But what explains that market disconnect?
It's not a market disconnect. People...
Well, the market's marking it down, and you said, well, the company's doing better than the market's telling.
I think it's very simple, Peter. People take their cue from price. If the price goes down, something's wrong. It must be a bad company. If the price goes up, everything's good. It's a great company. But in actual fact, the prices move around for a whole host of reasons, often nothing to do with the underlying business. And so we try and ignore that, and we just think about the business. And that's why I've said to you very early on when I first came on the program, we focus on businesses, not stocks. Everyone else is focusing on betting on the up or down, and we're focused on buying businesses. And what flows out of that? We can ignore price or take it as an opportunity rather than it be influenced by it.
But you and I have talked that once you've analyse the value of a company.
Yes.
Then you look at the price and say, well, that price is ridiculous considering the value of the company.
And that's the whole idea. You're taking advantage of it. The way I think about it is, you've inherited a farm from your dad or your grandfather. It's debt-free. You're going to have a few good years, you're going to have a few bad years, but over the average is, you're going to be fine. And because there's no debt, you're under no pressure to sell. The stock market is the guy on the side fence yelling out, Peter, I'll buy it for this, and next day I'll buy it for this, and the next day I'll buy it for that, and the next day I'll buy it for that. You can listen to him, or you can just ignore him. And we choose to ignore that. And I think there are viewers who really, really are concerned because they're retired and their wealth is attached to that balance on their CommSec account, for example, and it's going up and down all the time.
Well, those idiots keep crying by themselves.
And that's the same as throwing your dice down or betting on black or red at the roulette wheel. If you've got good businesses, like we've talked about Vita Group, we've talked about HealthScope, we've talked about TradeMe, we've talked about Certex, we've talked about CSL. All of them came out with absolutely stunning results. Altium, which is that printed circuit board, I talked only about it a couple of weeks ago. You know, and that business has reported 20% revenue growth. Its EBIT margins went from 29% to 32%.
It's a relatively small company too, isn't it?
It is a small company. Cash flow was, you know, terrific given that they had to pay a very big tax bill. They're forecasting that revenue will go from $93 million today to about $150 million in,
do you agree?
In just 4 times. I think they could do it easily. I think they could potentially exceed it. They're capturing market share. They are supplying software that electrical engineers use to make printed circuit boards for electronic devices, which, by the way, are proliferating thanks to the Internet of Things. So, you know, they're in a great space and they're capturing market share. And if you're a company using their software and you decide you want to switch, you know, the downtime of your workers to learn a new programming language in order to print these circuit boards or design these printed circuit boards, it's going to take 4 months.
So you're saying a lot of customers are very sticky.
They're rusted on and they're growing.
Okay, what about, I guess this is an important point, that sometimes a fund manager may well have made a lot of money out of a company like Isentia and they want to go and buy another company, so they simply take their profit, which will drive the price down.
Which is one of the reasons why the share prices go down. Or people read someone's blog, you know, and the blog said it was bad, and so they sell it because they believe what the blog said. And then, you know, then I'm sitting here with you saying that's wrong, that analysis is wrong.
Roger, are there a lot of, or a number of fund managers who are short sellers who do try to plant stories in the media to try and rattle? I know there's a CEO who says he thinks he's been a victim of that. Fortunately, his company's done well, his share price has gone the other direction, but he thinks he's been a victim of it. So
there are short sellers whose modus operandi is actually to do that. So they put together a 100-page slide deck of all the reasons why a particular company is no good. And then they get in the media and they start talking about it, and people are convinced. They don't do their own work. They just say, that guy's done the work and I believe him. And by the way, that's a very dangerous thing to do, even if people are following Montgomery. And because we'll change our mind, you know, we can change our mind. New information comes to us and we'll be sellers after we're buyers. But we don't do that. And the problem with doing that for that fund manager, sometimes I think they've not thought through the consequences. If you have been covered in the media broadly as panning a particular company, then it's much harder for you to change your mind. You know, it's just much harder.
But could they be prosecuted by ASIC if they are actually trying to undermine a company?
Well, there's nothing illegal. There's nothing illegal with me saying to you, I own the companies that I've mentioned. I own Altium, I own VT, our clients do, our funds do. We own these companies. Here's our thesis. You can agree with it or you can disagree with it. And it's never... See, what people don't understand is no skin off our nose if people disagree with us. Every time we buy a stock, someone sold it to us, we disagreed.
OK. Those companies, again, you mentioned, do you think there's still buyers at these levels, given how well they reported?
So we think Altium, out of all of those, and I'll mention them again, CSL, Certex, TradeMe, HealthScope, Vita Group and Altium. Out of those, Altium is still at a discount. Our valuation has gone up substantially. We think it's worth a lot more than it was before, and we think it's still good value, even though the share price has gone up a long way since we bought it.
You always like Challenger? Do you still hold a positive view on Challenger?
We still hold a positive view on Challenger. We understand that if interest rates go up or credit spreads widen dramatically in the credit market over the next few years, that will have a detrimental short-term impact on their mark-to-market, on their asset and liabilities, but in the long run, it's a great story.
Yeah, and a lot of advisors are now actually tipping annuities into their overall mix.
And it's potentially going to be mandated into superannuation funds.
That's true. Mate, thanks for joining us.
It's a pleasure, Peter.
That's Roger Montgomery from Montgomery Investment Management, is that right?
Yes. Thanks.
I wasn't sure it was asset management investment.
Oh, no, that's the Montgomery Fund.
OK. That's the show. Thanks for watching this week. Don't forget, Best of Switzer over the weekend. And Weekend Switzer, I'm doing a special story on Jerry Harvey. Switzer.com.au. See you next week.